units, 2023, 50,000, and then you're given the growth rate. And then we have the selling price per unit, 500, the growth rate, 5%, direct material cost, 90 shillings per unit, growth rate, 10%. Then we have the direct labor cost, which is basically 200. The growth rate is basically what? 10%. Variable production of hides per unit, 40, growth rate, 10%. Fixed production of hides, 100,000, growth rate, 5%. Administration of hides, 80,000. And basically that amount, because you can see it's not be given per unit, that automatically is a fixed cost, a growth rate 5%, variable selling and a distribution cost per unit 30, which basically give us what? And actually the growth rate is 10%, fixed selling and distribution 60,000, growth rate is 5%. So what we are required to do here is we prepare the forecasted statement of profit or loss given the current projections. Roman 2, we are required to determine the break-even levels in units and also revenue for the next 5 years. And number C, we are producing a graph, present the summary of revenue, profit, break-even, revenue for each of the next 5 years. So these are very, very simple question. It's a very good question here. We are going to start with part A. Part A of the question, whereby we are required to do what? We are required to do what? We are required to prepare the forecasted profit statement given those particular projections. So this will be our solution here. Will be our solution. And we are going to start with part A. Part A of the question, what are we required to do here? We're required to prepare the forecasted statement of profit or loss. So basically, what we are told, operating in a country different from the parent company countries of operation. Like in this case, we may be told that a company which operates in Kenya has acquired a subsidiary which is either operating in Uganda, in TZ, or maybe like in Rwanda. So that particular subsidiary is operating in a different country from the parent company countries of what? Of operation. So such a subsidiary, we refer to it as an overseas or basically a foreign what? A subsidiary. So therefore, this is basically a subsidiary company, which is operating in a country different from the parent company country of operation. Country of what? Of operation. Country of operation. For example, in this case, we may be told that a company which is operating in Kenya basically has acquired a subsidiary which is, for example, operating in what? In Rwanda. So the parent company operating in Kenya, the subsidiary is operating in what? In Rwanda. So this is basically a foreign or basically overseas what? A subsidiary. Now, in this case, how do we prepare the group account here? The first thing which is important for us to appreciate here is that the Kenyan currency basically is the Kenyan shillings. What is the name of the currency for Rwanda? The currency for Rwanda is known as what? Who can tell us here? The currency for Rwanda. The currency for Rwanda is known as what? Who can tell us? The currency for Rwanda. So the currency for Rwanda is known as Rwandan franc. Is known as what? Rwandan franc. Just like if you go to TZ, their currency is Tanzania shillings. If you go to Uganda, their currency is Ugandan shillings. If you go to Rwanda, they use a currency known as Rwandan franc. Rwandan franc. So basically, you can see that these two companies here, they basically prepare their financial statement using a different currency, using a different what? Currency. So this one, the parent company prepares financial statement using the Kenyan shilling. This one using the Rwandan franc. It is obvious that if you are preparing the group account, there is no way you can do a direct consolidation. You can do a direct consolidation. You take the asset and liabilities, revenue and expenses of the two companies, you combine them. You can't do that because you can see those currencies are different. The financial statements of the parent company is prepared in Kenyan shillings, and the financial statements of the subsidiary are prepared in what? In Rwandan franc. So in this case, we are going to look on how do we translate. How do we do the translation? But even before we do that, we look on that, and maybe there are some two terms we need to define here. One is something called a presentation currency. the presentation currency, and also something called the functional currency. The functional currency. So when talk about the presentation currency, this is basically the currency which is used by the parent company in preparing the group account. The currency used by the parent company, currency used by the parent company, to prepare the group accounts, to prepare the group what? Account. In most of the cases, if the parent company is a Kenyan company, this one will be preparing the group account in Kenyan shillings. If the parent company is a Kenyan what? Company, it will be preparing the group account using the Kenyan what? Shillings. But that currency used by the parent company to prepare the group account is called the presentation currency. On the other hand, we talk about the functional currency. The functional currency, this is basically the currency, the currency of the primary economic environment, the primary economic environment in which a company operates, in which a company operates, in which a company do what? Operates. So basically that local currency of the country in which the company operates. So if the parent company is operating in Kenya, the functional currency is Kenyan shillings. If the subsidiary is operating in Rwanda, the functional currency or the local currency for that country is Rwandan what? Is Rwandan franc. So therefore, in this case, when preparing now the group accounts, we are saying, before you proceed basically to do the consolidation, before you proceed to add assets, liabilities, revenue, and expenses, those of the parent company, this particular foreign subsidiary, it is important for the financial statements of the foreign subsidiary to be translated into the presentation currency. Into the presentation what? Currency. Remember, you say the presentation currency is that particular currency which will be used by the parent company in preparing the group account. If the parent company is operating in Kenya, it will prepare the group account using what? The Kenyan shilling. So therefore, before we combine similar items of asset, liabilities, revenue, and expenses, those of the parent company, those of the foreign subsidiary, asset, liabilities, revenue, and expenses of this company, that is a foreign subsidiary, must be translated into Kenyan shillings, which is the presentation what? Currency. So how do we do the translation? These are the translation rules. These are the translation rules. These are the translation rules. And this basically what is very, very important you need to remember. Number one, when translating the items of incomes and expenses, items of incomes and expenses, and remember in this case, what we are translating are the incomes and expenses of this foreign subsidiary. So we translate them, they are translated, items of incomes and expenses are translated using something called the average exchange rate. The average exchange what? The average exchange rate. Because in both of these particular questions for foreign subsidiary, you'll be given usually 3 exchange rates. You'll be given the exchange rate at the start of the year, the exchange rate at the end of the year, and also will be given the average. So in this case, we translate incomes and expenses of this foreign subsidiary using what? Using the average exchange rate. The average exchange rate. Number 2, when translating the assets and liabilities, the assets and liabilities of the foreign subsidiary into a presentation currency, these ones are translated using the crossing exchange rate. The crossing exchange rate. This is actually the exchange rate at the end of the year. The exchange rate at the end of what? Of the year. So if you're able basically to know that, then this particular question, or the question for preparation of group accounts whereby we have a foreign subsidiary, they become very, very simple. But it is obvious that in the process of translating the assets, liabilities, revenue, and expenses of this foreign subsidiary into a presentation currency, there is something which is known as the translation, or basically yes, the translation currency difference, or can we just refer to it as the exchange difference? Exchange difference. In other terms, we refer to this as the currency translation difference. Translation difference. difference. Currency translation difference is basically an exchange difference which arises from translating the items of asset, liabilities, revenue, and expenses of this foreign subsidiary into presentation currency, of which in this case we are going to see this currency translation difference or this exchange difference can either be a gain or basically a loss. Can either be a gain or a loss. Now, this particular gain or loss, we can say this arises due to a translation. This arises due to translation of basically three items. One of it is goodwill. Is goodwill on acquisition. Number two is a profit for the year. And number three, the subsidiary company opening net assets. So opening net assets. Opening net what? Assets. So we are saying that this currency translation difference, which arises as a result of translating the items of asset, liabilities, revenue, and expenses into presentation currency, it basically arises from the translation of those three items, So I want us to look on how we determine this currency translation difference, which basically arises from translation of those three items, the goodwill, profit for the year, and the opening net assets of the subsidiary. So let's start with the goodwill. So remember, goodwill, this is the difference between the purchase consideration paid by the parent company and the net assets which were acquired. So basically, what is important, first of all, to note here is that when computing the goodwill, first of all, we compute the goodwill, or basically we say that goodwill is computed using the fractional currency, the fractional, remember, is the local currency. For example, the local currency of Kenya is Kenyan shillings. The local currency of Rwanda is Rwandan franc. So first of all, we compute the goodwill using, the goodwill is computed using the fractional or the local currency of the foreign subsidiary subsidiary. So if the foreign subsidiary is operating in Rwanda, what you do when computing the goodwill, first of all, compute the goodwill in Rwandan franc. You compute the goodwill in Rwandan franc, not in Kenyan shillings. Compute that using Rwandan franc, and then translate it, into presentation currency. Translate that into presentation currency. So compute that goodwill using the functional or the local currency of the foreign subsidiary, then translate that into presentation currency. In the process of doing that, we have an exchange difference. How do we compute that exchange difference? I want us to look on how we compute the exchange difference arising from the translation of goodwill. So basically, for us to be able to look on how we determine this, we need to have like a number of columns here. So here we have, in this case, I will assume our parent company operates in Kenya, but the foreign subsidiary operates in Rwanda. So here we will have now the local currency of the foreign subsidiary, assuming it is Rwandan franc. This is basically the local currency of the foreign subsidiary. We have a column here for the rate of exchange. You'll be given the exchange rate between Kenyan shillings and the Rwandan franc. So here we have a column for the exchange rate, and then here we translate that into presentation currency, which is the Kenyan shilling. So here we always start with the goodwill on acquisition. The goodwill at the date of acquisition. You'll be able to see in all these particular questions for foreign subsidiary, this particular foreign subsidiary is always acquired at the start of the current year. is always acquired at the start of the current year. So therefore, what we do, we compute this goodwill on the date of acquisition, which is always at the start of the current year. And I've said we compute this goodwill always using the fractional or the local currency of the foreign subsidiary. So if the subsidiary is operating in Rwanda, we will compute that goodwill using the Rwandan franc, this one. Then we translate that into Kenyan shillings using which exchange rate? The opening, O for opening. O for opening, the opening exchange rate, the exchange rate at the start of the year. We get the value there. And then out to this, what we do is that we less any impairment loss. This particular goodwill automatically will have impaired. So we less impairment loss here. And because this impairment loss is an expense, you have to remember what you have said here. Any item of income or any item of expense will be translated using which rate? Which rate? The average, A for average. Maybe you can just note that somewhere, A for average. And then we get now the impairment loss in what? In Kenyan shillings. So then we take this minus that, and basically you read one line here, that now will give us the value for goodwill at the end of the year. This will be the value of goodwill at the end of the year, and that is the date we are doing our consolidation. Remember, doc is the date of consolidation. So this will be the value for the goodwill at the date of consolidation, which will be at the end of the year. Then we take this particular goodwill, we translate it now into presentation currency. And in this case here, because it's an item of assets, and we are translating that at the end of the year, now we have to use which exchange rate? We use the closing exchange rate. We take this, we translate it into presentation currency using the closing exchange rate. We get the value there. The value there. Then for us to be able now to compute this exchange difference, what we do is that we compare the value which we will have gotten here, this one with this one. So we compare these two values here. We compare these two values, this and this, of which in this case we can have an increase. Maybe from this to this, we can have an increase. Or basically from this to this, we can have what? A decrease. We can have a decrease. So that increase or decrease is what we refer as exchange difference. And this exchange difference can either be an exchange gain or an exchange what? Loss. So if basically we have an increase, maybe from here we have 80 million, but here we have 100 million, you can see we have an increase. An increase is a gain. The value for goodwill increased is a gain. An increase is a gain. But if we have a decrease like 80 million to 60 million, that is a decrease. A decrease is basically what? An exchange loss. An exchange loss. An exchange loss. Now, this particular exchange gain or loss, this exchange gain or loss, this one will be recognized in the consolidated income statement. In the consolidated income statement as part of other comprehensive incomes. Will be recognized in the consolidated income statement as part of other comprehensive incomes, part of other comprehensive incomes. So we know other comprehensive incomes, we add this to the gross profit. Not to the gross profit, sorry, we add this to the profit for the year, to the profit for what? For the year. So that's basically how we compute the exchange difference or the currency translation difference, which arises from the translation of what? Of goodwill, translation of a goodwill. So then from there, once we look on how we compute the exchange difference arising from translation of these two items. So the exchange difference arising from the translation of these two items, profit for the year of the subsidiary, opening net asset of the subsidiary. This one is computed. We compute the exchange difference together here for those two items. The exchange difference on translation of those two items. So here we need to have the same columns, the local currency of the foreign subsidiary, the exchange rate, and the presentation currency. So always here we start with the opening net asset, the opening net asset. These, in other terms, are the net asset of the subsidiary on the date it was acquired. Remember, we have said in all these questions for foreign subsidiary, our foreign subsidiary will have been acquired at the start of the year. So take the opening net asset on the date of acquisition in in local currency, for example, Rwandan franc. Translate that into Kenyan shillings using the opening exchange rate. You get the value there. And then to this, you add the profit for the year. the profit for the year. And remember, this is the profit for the year for the subsidiary. In case there is some adjustment affecting or which should be effected in the income statement of the subsidiary, like a depreciation, other charge, maybe something like amortization, which was not accounted for by the foreign subsidiary as a result of fair value adjustment. Remember, we said whenever the subsidiary has been acquired, the subsidiary can revalue assets, like maybe item of PP or even things like intangible assets, like maybe brand or something like that. So if that the foreign subsidiary revalued some assets, automatically it's never accounted for that. So if it is an item of PP, you have to compute the depreciation at the charge. You are adjusted to this profit. If maybe it revalued an intangible asset like brand, compute the amortization adjusted to this. So you have the adjusted profit for the year. And because these are profit, you translate it into this into presentation currency using which exchange rate? Using the average exchange rate. Using the average exchange rate. The average exchange what? The average exchange rate. And then basically what we do down here, you leave two lines there. What we will have here is the crossing net assets. The crossing net asset of the subsidiary. We translate that now into presentation currency using the crossing exchange rate. Using the crossing exchange rate, we get now the translated value there. And then we take this plus this, and basically we compare these two. We compare this with that, just like what we have done down here. So the difference which you get here is what is known as the exchange difference, or actually this one would be the exchange gain, or the exchange what? Loss. So if from this to this, remember this net assets. So just like goodwill. So if from this to this we have an increase, is an exchange gain. If we have a decrease, is an exchange what? Is an exchange loss. Is an exchange loss. And equally now this one will be recognized within the consolidated statement of profit or loss, or the consolidated income statement as part of other comprehensive what? Other comprehensive incomes. Will be recognized there as part of the other comprehensive incomes. So basically, this is how we compute the exchange difference. That is the exchange gain or loss arising from the translation of the various items of assets, liabilities, revenue, and expenses of the foreign subsidiary, of the foreign what? Subsidiary. So once you come across this particular question for for foreign subsidiary, usually maybe in Roman 1 of the question, the examiner will require to compute this. The exchange difference or the currency translation difference arising from the translation of goodwill and also the profit for the year and the opening net asset. That's basically how you do that computation. Roman 2, then you'll be Roman 2, Roman 3, you'll be required to prepare consolidated income statement, consolidated statement of financial position. I've said for you to prepare number 1, the consolidated income statement. So before you even, or basically when combining the revenue and expenses of the parent and that of the subsidiary, you'll take that of the parent, which is already in presentation currency, but you have to translate that of the subsidiary. We have said that all these items of the subsidiary will be translated using the average. All items of the income statement will be translated using the average exchange rate. But the items of assets and liabilities, those of the foreign subsidiary, will be translated using the crossing exchange rate. Crossing exchange rate. So if you can be able to record that, basically this one is quite simple. Quite simple. And I think with that particular knowledge, I want us to go straight to a question. We go straight to a question on a foreign subsidiary. On foreign subsidiary. Usually, this is one of the areas which is very simple. You'll be able to do that. You'll be able to see that. One of the areas which is very simple. Very simple. Yes. I want us to do a question with both the income statement and the statement of financial position. And basically the question I want us to start with. Yes, so let's start with this one. April 2022. April 2022, which is the question number 1. Question number one. April 2022. So if you're there, you can just confirm. Yes, are you there? Are you there? Okay, okay. So what are we told here? What are we told? What are we told here? We're told that P Limited is a public limited company listed in the securities exchange. Listed in the securities exchange. It has diversified its activities by acquiring S Limited, a company domiciled in a foreign country. Both companies prepare their financial statements in accordance with international financial reporting standards. The presentation currency of the group is Kenyan shillings, while S Limited functional currency is franc. Remember, I've explained what is the meaning of those two currencies. Presentation currency is the currency used by the parent company to prepare the group accounts. We are told is Kenyan shillings. But now, this foreign subsidiary, which is S Limited, it operates, we are told, is domiciled in a foreign country. Its functional currency, the local currency of that foreign country is franc, which is denoted by FR. And then you're told the draft financial statement for the year, which ended 31st of December 2021, and set out below. So we're given the statement of profit or loss for the parent and that for S. You can see the statement of profit or loss for the parent company is in Kenyan shillings, but that of the foreign subsidiary is in franc. That's why I say, if, for example, now you're preparing the consolidated statement of financial position, there is no way you can do direct translation. Sorry, direct consolidation. That is direct consolidation. You take the revenue and expenses of the parent, you add with that of the subsidiary. You can't do that because you can see those that statement of profit or loss of the parent, that of the subsidiary are in different currency. That's why we have said even before you do the translation, we translate those items of the foreign subsidiary into presentation currency, which is Kenyan shillings. So then from there we have the statement of financial position for the two companies, P and S. Equally, you can see the statement of financial position of the parent is in Kenyan shillings. That of the foreign subsidiary is in franc. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 5. What are we required to do here? We are required to determine the exchange difference, which is basically the gain or loss arising from the retranslation, or basically arising from the translation of the net assets and the goodwill on acquisition of the foreign subsidiary. Part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 31st of December 2021. And then from there, we are required to prepare the consolidated statement of financial position. So before we even do that, I want us, we come up with a group structure. Let's come up with a group structure. A group structure. And the group structure. So where do we have information about the group structure? We have that information in note number 1. Let's go to note number 1. In note number 1, you're told on 1st of January 2021, the company which is called P Limited acquired 80% of S Limited, 1 million 1 franc ordinary shares for a cash consideration of 3550 million franc. So this company acquired 𝐻 Limited, and basically this 𝐻 Limited, remember, we are told is domiciled in a foreign country. Is domiciled in a foreign country. Is domiciled in a foreign country. In other terms, is a foreign subsidiary. In other terms, is a foreign. Yes. So in this case, we have the parent company and basically the foreign subsidiary. As per that note, we are told the acquisition took place on 1st of January 2021. So that is the date of acquisition. Remember, I've said in all these particular questions for foreign subsidiary, usually the subsidiary is acquired exactly at the start. So it was acquired on 1st January 2021. That is the date of acquisition. When are we required to prepare the group account? The date of consolidation doc. So in the requirement, specifically in Roman Part B and Part C, we're required to prepare the group account for the year which ended 31st of December 2021. You can see our subsidiary was acquired exactly at the start of the year. Sasa, yes, we say it's always important for you to note the date of acquisition. So we have that information there. That is the group structure. P is the parent, S is a foreign subsidiary. Now, in that case, we are given the purchase consideration which was paid, which was 3550, and actually this is in franc. Then no working which is required there, but we are going to use that information in computation of goodwill. In Part B, also not Part B, rather note 2, we are told at the acquisition date, the carrying value of 𝐻 Limited net asset was 2600 million franc, but the fair value was 3200 million. In other terms, this company revalued the assets. On the date of acquisition, revalued its net asset. We are told the net asset had a fair value of 3200 million franc, and the carrying amount of this net asset was 2600 million. So it basically means that in this case, we have an increase in the value of the asset by 600, which automatically is a revaluation what? Gain, is a revaluation gain. So, and then you're told the excess in the fair value of the carrying amount was due to unrecognized branch with a remaining useful life of 5 years at the date of acquisition. So we are told this revaluation gain is due to a brand. In this case, a brand is basically a form of a trademark. In other terms, a brand, this one, this is a form of an intangible asset. This is a form of an intangible asset. Just like the other question we did, whereby we were told that the subsidiary on the date of acquisition valued, or basically there was a list of customers which was not yet recognized. And we say that list of customers should be recognized as what? As an intangible asset. The same case with this particular brand. So what is the value for the brand? So the unrecognized brand. Unrecognized brand. And basically we are saying that this unrecognized brand, this is a form of an intangible asset. A form of an intangible asset. So the value for this brand will be the difference here. It will be equal to 200 million franc minus 26. This will be 600, or this will be 600 million franc. Remember, this particular asset here was revalued on the date of acquisition. So how are we going to account for this amount here? This amount of 600. So this amount of 600, number one, this one will be recognized as an intangible asset. As an intangible asset within the consolidated statement of financial position is an intangible asset. Number two, this one is a pre-acquisition revaluation reserve. Is a pre-acquisition revaluation what? Reserve. So that's the first thing you need to know. And then in the same point, we are told that this particular brand had a remaining economic useful life for 5 years at the date of acquisition. Remember, I think in most of the questions which you have done, we were told the item which was revalued was an item of PP. What we were doing, we were computing the depreciation under charge. In this case, do we depreciate intangible assets? No, we amortize. So what we need to do here is basically we compute the amortization, because what we say is that once the subsidiary company has revalued the asset, the subsidiary company do not account for that revaluation. So what we need to do is to compute the amortization for this brand. The amortization, we compute this using the same formula we were using to compute the depreciation under charge. We take the revaluation gain for the value at which the asset was revalued at, We divide that with the remaining useful life or economic life. And I think we are told the remaining economic or useful life in note number 2 were 5 years. 5 years, we divide that with 5, and then we should multiply that with the proportion of time. The proportion of time is the time we have between these two dates. In this case, we have 1 year. So we are interested with amortization for just 1 year. For just 1 year. So this will give us what? This will give us 120 million. And it is also important for you to note that this 120 million, this is still in franc. This is in foreign subsidiary. This is in foreign what? Subsidiary. So this one, this amortization, number one, this one is basically an